Hello and welcome. You're watching The Big Picture with me, Frank Razan Ferreira. Asian markets were mixed in early trading on Wednesday as investors remained unnerved about the global economic outlook. US Treasury yields saw little change Tuesday as the bond rally paused, while new data on Wednesday showed China's industrial profits dropped sharply in the first 2 months of the year, raising worries of a slowdown. The US and China will resume high-level trade talks on Thursday in Beijing. Despite global slowdown fears, Indian markets rallied on Tuesday to regain all of Monday's losses. For domestic markets, the hope is that emerging markets like India may be safe havens investing options amid all the chaos about US slowdown and Brexit confusion. On this edition of The Big Picture, we will take a look at the state of the global economy. Joining me on the program today are Jayant Das Gupta, former ambassador of India at the WTO, Ajay Dua, former secretary, Ministry of Commerce and Industry, and A.K. Bhattacharya, editorial director of the Business Standard. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Dua, I'd like to begin the program with you. First, let's try and analyze and try and gauge what is the state of the global economy as it stands today.
I would say that Europe is pretty much on the decline. Brexit could be a cause, but that's not the only cause. We've seen a fair amount of slowdown in almost every major economy as well as a medium-sized economy in Europe. Yesterday, the ECB head, Mr. Draghi, elaborated at length about on the media what's happening in Europe, and he didn't seem very optimistic, comparing the current state of affairs to the last year and the year before. And we used to think last year that things were not so good, but this year seems to be worse. On the US side, I'm looking at the largest bloc in Europe and then the US. The US, in whatever might be the president's claims, but though there is some data to the contrary, also in support of what the president might be claiming, fact of the matter is that the trade war with China, if it escalates any further, I think it's going to hurt both the countries. China is already reeling under its pressure.
Right.
The fact, again, I'm saying that the position is that the US is right now not experiencing the full damaging effect of the relationship with, or the business relationship with China, because the shale, it's been able to resume exploration on shale, which had stopped when the prices of oil had fallen down. The employment data looks supportive of the president, saying that there is a build-up of some America in the American economy of the on account of job creation. China, by its own admission, is facing a slowdown. The Prime Minister in the last CPC conference has asked the countrymen to sort of brace up and saying that we can no longer be growing at the rates of growth which we were earlier. When we all understand, if you are an economy of the size of $12 trillion, growing at even 6% must be taking a toll.
Right.
And you can't go on a double-digit growth for longer than 2 decades, which it has done. And what I picked up from Mr. Draghi's statement yesterday was he was of the opinion that the emerging economies of the world are also slowing down, which probably he clubbed India into it. But if you look at it as a group, that the year forward to him didn't appear to be very rosy.
All right. That having been said, Ambassador Das Gupta, what kind of an impact has the trade war between the US and China had on the global economy?
The Chinese economy, for instance, though exports and imports, if you add them together, they account for less than 30% of the GDP of China. But China, compared to the size of the Chinese economy, it is a huge amount. And because of the slowdown of the Chinese economy, partly on account of the trade war going with the US, Chinese imports have have slowed down considerably, and there is a lot of uncertainty looming ahead, because it's not very certain from what news is emanating from Washington whether there would be a quick resolution of the dispute between the US and China, or whether it would drag on. Because last week, I think there were news items which suggested that unless China agreed to change its subsidies regime and the state-owned enterprises, the way they are run, there would be difficulty in arriving at an agreement. So the countries which were dependent on China as part of the value chain for producing components and for also finishing the products which were coming basically from China, they are all affected. So this has affected the Southeast Asian economies a lot. This has affected raw material exporters like many countries from Africa, many countries from South America, for instance. And it has, but the effects of this are being felt, but they are still, people are still hoping. Now, there are estimates that the US-China war, trade war, has already cost at least 0.1% of US GDP. And according to certain estimates, the tariffs which have been imposed on Chinese products by the US have actually been passed on to the US consumer. And this has led to inflation in the US.
Right.
So it has had many undesired and unpredicted outcomes.
Right.
From the US perspective.
Sure.
And from the Chinese perspective as well.
Right. Mr. Bhattacharya, so I'm going to go back to the points that Mr. Dua was making. He's saying that the outlook doesn't look very bright. In fact, it looks, glim at this point in time. But what are the most worrying factors for you?
Well, the number one is that although we tend to underplay how the market reacts, I think the investors in the bond market are a clear sign that there is nervousness as far as economic revival in the US is concerned. In the last 50 years, whenever the bond yields have become inverted, in a sense that when the 10-year bond yield are actually lower than the 3 months bond yield, and this has happened yesterday. Now, for the last 50 years, whenever the bond yields have been inverted, there is a recession of sorts that has appeared. That's number one. And number two is that this is probably, from 2008 onwards, this is probably the longest US bull run that we have seen. Now, this had to end. There were fears that it will end last year. I think it's got prolonged. And I think it is now coming to an end, and that fear has also gripped the market. Number three, the housing sector, the US housing sector, a clear indicator of what is in store for you, is actually showing a fair degree of softness. New demands are actually dropped. So therefore, in the overall scenario that you see, the US market is clearly gearing up for a kind of a slowdown, resulting in what you don't know. So as a result, Fed has already sort of put on hold its plans for raising interest rates, and actually there are expectations after this inverted bond yield curve that the US Fed actually may have to lower the interest rates. So I think on the whole, this has impacted the global sentiment. You have, as Mr. Dua, Mr. Dasgupta pointed out about the US-China trade war, you have the Brexit fears, you have Germany, Europe's engine for growth, is actually stuttering with the first quarter seeing a contraction, last quarter, and the second quarter results are going to come very soon. One doesn't know what will happen. You have China, who is, as you rightly pointed out, that industrial production has suffered. So I think on the whole, I am not very optimistic about any uptick on the overall global economic climate. On the contrary, probably it is time to prepare for a kind of a flat growth scenario,
right.
which I think the markets are very clearly indicating.
A flat growth scenario is much better than the recession. Are we on the verge of a recession, Mr. Dua?
A prediction for the US by our Indian with the Morgan Stanley, Ruchir Sharma, is that 2020-21, that means next financial year, probably we would see the US slipping into a recessionary mode. Not that I'm quoting him as a gospel's truth, but the fact of the matter is that the signs of all that have started to emerge, that you can't rule out the possibility. And if you recall the last prolonged recession of the US, 2008, 2009, the housing market and the bond yields, a point which just now made, were the indicators which the market didn't pick up. You know, 2007, 8, and whosoever we have driven it, no need to postmortem that. But ignoring such indicators, saw major collapse of the financial sector. Something which, if the US government hadn't intervened the way it did, most other countries would have seen the monetary system go for a 6. So, second, the emerging markets, which includes India, right now, last 1 month, is a deviation from what we were seeing on the capital markets of India till February end. Right now, the money which is available, seeing the slowdown in Europe and the US, that the FPI, it looks like $2 billion net flows have occurred during the current year into the Indian stock market, which is because I think this is money which was in the pipeline. It is not long-term call saying, okay, we can't invest there. The broker receives an instruction, put it in that other market.
Right.
We are probably benefiting from that. And also in India, emergence, likelihood of a stable government itself has propped up the sentiments about investment in India. What actually happens or not, but probably in early March, it did appear to foreign investors that compared to the earlier 6 months or so when there was uncertainty about political outcome, probably that was overplayed, that India could probably have a stability in government, and that would have also prompted people to invest in the equity market.
Right.
Finally, I think Europe is in for uncertainty. No one knows whether Brexit will occur or not, and on what terms. Today something is happening in the House of Commons where the members have taken over running of the House, and that it's a freewheeling discussion. But I think at the end of the day, all signs are pointing out towards an exit without a deal.
Right.
If that happens, then I think the UK economy will suffer much more than what has been already built into the prediction for Europe as a whole.
Right. So, Ambassador Dasgupta, what I'd like to understand from you is what kind of an impact will the slowing down of the US economy have on the world?
The first thing is that the US has, for more than 50 years, been the driver, been the engine of growth for the world economy. It has been a huge consumer of products and services which have been produced in other countries of the world. And it has also been at the forefront of technology. Now, if the US, for instance, consumes less, or there is stagnation there, and there are already indications that the growth will come down to about 2.1% from close to 3% earlier, the US will not be able to provide that kind of fillip to the global economy to increase the production of different kinds of products and services. So this will have a kind of a spin-off effect on other economies which also were supplying goods and services to the US for third country exports. So this will be one dampener. The second thing is that the Chinese economy is next only to the US now at roughly between 12 and 13 trillion dollars. Now with that also slowing down, and the third issue is about Europe. Italy is already in recession, Germany is on the brink of recession, and if I may just point out, the North American CFOs, there was a survey and they were quite pessimistic, and they said that there would be a recession in 2020. And Goldman Sachs itself has said that there is a 50-50 chance of a recession by about 2021. So the indications are there from the housing market in the US, and the bond yield, which is something which we are all looking at very closely. The final point I wanted to mention about the US economy is something which I read the other day about Janet Yellen, the previous chairperson of the Federal Reserve. She has pointed out that the US employment which has been taking place, is in retail services and low-paying services, and it's also quite, the distribution is part-time employment. So she says that there are a large number of people who have stopped looking for jobs because they have become disheartened. Now, and she has given an estimate that actually there should be, the real unemployment rate is probably twice as much as the rate which is being quoted. So if that is so, the consumption or the purchasing power of the people in the US is either stagnant or going down in real terms. So that is something which is very worrisome, along with the condition in Europe and that in China.
Right. So Mr. Bhattacharya, how do we brace for all of this?
Let me try to be contrarian here.
Right.
I think that globally, I think it's bad news economy-wise. I think US, as my esteemed panel colleagues mentioned, is bad news all over Europe, China, US. I think it's time for India to set its own house in order, in my view. And I see it as also a possible opportunity, because as Mr. Dua was mentioning, that the FII flows will increase, and if indeed the bond yields are like that, and if the interest rates actually go down further, or it at least doesn't rise, you are going to see a flood of money coming into Indian shores. Now, I think that will be a challenge. How do you sterilize that kind of flows, and how do you channel that kind of flows into productive investments? So we need to be prepared to use that extra flow of money coming into the system and use it for productive purposes. We need to be ready for that. Number two, you will see a lot of the commercial borrowing market will open up a bit. So for Indian huge big projects, it will be an opportunity to negotiate for better rates and get better terms for investments in India. And finally, if we can get our own the fiscal situation and can keep it under control, then my sense is that we are not yet and nowhere near a net exports country. So if you are not a net exports country, yes, the exports climate is looking very, very, very pessimistic. So we probably have an opportunity in meeting the huge infrastructure demand that is waiting to be met in your own country. So I think while the world global the superpowers, the economies actually are wrestling with the pangs of a slowdown or a recession, you may call, but probably in the Indian economy can actually, if it is managed well, and I'm saying it deliberately because we are getting into an election mode, and if the new government, whichever government it may be, can actually put forward and put together a policy framework that can take advantage of the situation with more flow of funds, easy flow of money, and use them for better returns and fixing the basic, the economic and social infrastructure in place, I would imagine that the overall the climate of gloom and doom probably will be less of a worry for India.
Yeah. So, Mr. Dua, that's very interesting that Mr. Bhattacharya raised that. The fact that we are in election mode, several promises are being made, manifestos will soon be out. So the fisc definitely needs to be concentrated upon because, you also have this precedence of, giving out doles and giving out farm loan waivers and so on and so forth. So this opportunity may be missed.
Yes, we've always seen post the elections, whether it was 2014 or 2009 and probably even earlier, that the consumption expenditure rises soon after the elections or during the elections. That is consumption, not really investment, capital formation, or because some of the money, people, they cannot be buying durable assets. Now that the income tax department is also a little more vigilant, they would have to explain where the money came from, which election party gave them or candidate distorts them. So it will all be reflected in the FMCG kind of daily consumption items. But that will certainly give a kick to the GDP post the elections because or first quarter of next year, because we are seeing that the Q3 slowdown in GDP was this time not because of investment being lower. In fact, there was an uptick in the investment, but private sector in consumption as well as the government sector consumption was less because the government also became concerned about fisc and the private people didn't quite have the money to invest. So this will probably bridge that gap. The important point raised by Mr. Bhattacharya, and I fully subscribe to that, is that if we are able to manage our expenditure properly, the world as such, whether it's the IMF or people who are investing in India, don't mind a developing economy having a little bit of a fisc, maybe 3%, 3.5%, as long as it is being properly used.
Right.
If it is only on consumption, if it is only on subsidies, that's what they resent much more. If it is, we say, we are spending it on direct benefit scheme, which will improve our healthcare expenditure, our education expenditure, rather than giving them through indirect means and through intermediaries, probably the adverse reaction on a higher fisc is much more likely to be contained.
Right.
So this is what I am looking for, the kind of reforms, as you said, whichever government comes, that we have to be rationalizing our subsidies and making sure that whatever government does, nobody in the world minds a welfare government. That means you are looking after your poor people.
Right.
But let that money for which what it is earmarked for actually reach them.
Yeah.
So I'm looking forward to that kind of reform and for our exports to build up, our competitiveness to improve, and increased expenditure out on infrastructure, particularly transportation and export related, etc., is all going to be in the positive side.
Right. Mr. Dasgupta, so do we need to be wary of something in the near future?
There are a few things which we should be watching closely. One of them is, of course, the energy prices, the oil prices. But they have been showing a relatively downward trend. So we need not worry too much on that count. And if there is indeed a slowdown in the economies of the West, the oil prices are not going to go up very much from their current levels. So that is one worry. The second worry is that, our exports have, of course, been more or less stagnant for the past 7-8 years. So even if they don't go up very much, but if they shrink, if they contract, then there would be implications in terms of lost employment. So that is the second worry. The third thing is, of course, I share Mr. Bhattacharya's views that there would be a lot of money coming into India if it manages to hold its head above the water and if it continues to grow at between 7 and 8%. So what will we do with that money? If it is only going to inflate the prices on the stock market, it's not going to be of much use. If we can somehow channelize that and provide that kind of confidence amongst the investors that their returns would be assured, and that we would give them a good return by investing it in our infrastructure, whether physical infrastructure or social infrastructure. That is the kind of assurance which the new government will probably have to give in order to channelize this money and utilize this perceived flow of extra funds into the Indian economy in a beneficial manner.
Right. And Mr. Bhattacharya, close the show for us with your concluding remarks.
Well, I think I will reiterate the point that was just now mentioned, that I think if indeed there is a global economic slowdown in the offing, one of its clearly perceptible benefits for India would be a flat energy prices. Now, I think India's 80%, 83% of India's energy needs are met through imports. And if you see a scenario in which the energy prices remain benign, I think the government should actually use that opportunity to not only channel more investments to areas, because that is a bonus for India, because 80% of your imports of your energy needs are met through imports. So the cost comes down. So it should use that opportunity to channel more resources for investment purposes, meet the infrastructure, the deficit that exists in this country, and most importantly, use that opportunity to reform the energy sector. And I think the last 5 years, in spite of many of those years, we have seen very soft energy prices. We did not see energy sector reforms being speeded up, except some mergers about which there were some protests also. So I think we need to really go in for a proper energy sector reforms using a globally benign oil prices scenario.
All right. All right, with that then I'll call it a wrap on this edition of The Big Picture. What's coming out of this discussion is that there could be a slowdown as far as the global economy is concerned, but it could pose an opportunity for us as well, and it may not be a risk. So we'll have to make use of that opportunity and do something about it, is what the panelists are suggesting. With that, it's a wrap. Thank you to all my guests for joining me on the program and putting things into perspective for us. See you again next time.